The Federal Reserve has signaled it might raise interest rates at least 2 more times this year before it considers a pause. Economist Jeremy Siegel tells Fox Business he thinks that's a mistake.
Jay Powell already says the biggest force of monetary policy works with a lag. It's sometimes 6 months, 9 months, 12 months. So this tremendous tightening, one of the greatest in history, its effects have not been felt. I would prefer that they stop now. I think there's enough evidence that the prices are down, that they could pause and wait and see the course. I think continued increases will increase the risk of a recession in the second half of this year.
He's saying it might take a full year. We might not be till 2024 before we see the ramifications here. What does this mean to the couple that's trying to, retire in the next year or so?
Well, with every hurdle, there's always an opportunity, right? And, the money market accounts right now, I met with a client, and in fact, Chaz, you helped me out with a couple of clients over the past couple of weeks, where I have a client that actually came into, a good chunk of money, and based on their age, they, aren't in a position really to do a lot of investing at their age. They're in their 80s. And aside from just putting it in the bank and letting it sit there, her bank was only getting 0.05. I'm like, this is ridiculous. So what we did was we actually opened up a money market account and actually were able to get a little over 4%, which is an opportunity during this when the interest rates go up. Me not traveling down the lane that you guys travel down with investments, I look at this and I think, okay, so if I don't have credit card debt, if I don't have mortgage, if I don't have any debt out there where the interest rates are really going to hit me and impact me, I'm looking at this as an opportunity to maybe gain a little in my accounts that we always refer to as lazy money, right?
Yeah.
So
I think that makes a lot of sense. I think you said something there too regarding going into retirement being debt free, or as close as you can, and keeping your expenses as low as possible. Because as Jeremy Siegel, I believe he's a Wharton Business School, probably one of the greatest financial minds of living history. I think he's right, and I think that's based a lot on his take on the Fed's inability to kind of dial in exactly what the course of action is. That's not just this recent Fed. If you think about it, 2008, 2009, where was the Fed then? They were not able to predict the recession. They weren't able to really necessarily navigate us out of it. So I agree. I think it's this pendulum with the Federal Reserve that always swings one way or the other. It's never right in the middle. It's either they're overshooting or undershooting the mark.
So you think they have like a knee-jerk reaction, right?
In some cases, yeah, I think that's correct. So from an investment perspective, like you said, it's an advantage to a saver right now to be able to lock in pretty decent interest rate on a fixed investment because of the Federal Reserve's aggressive interest rate policy, where they've taken these rates up that companies and businesses and people borrow at. And like you said, when there's higher interest, you think twice oftentimes about taking money out and making new improvements and spurring the economy along. But for retirees, I think it comes down also to that you need to be able to be in a position to control what you can control. And that's one of the main concepts that we talk about at our economic events, or that we can diversify as much as we want individual stocks and risk, but sometimes there are these events that you cannot plan for, like aggressive monetary policy. And unfortunately, if it hits right before you go into retirement, there's not a whole lot you can do about it at that time. So we really have to have a plan in place. We can't predict it, but we can have a plan. And so the first part of the plan really comes down to understanding that the inflation is going to affect all types of Social Security, or all types of income, rather. So inflation is going to impact all types of income, whether it's your Social Security. Now, often there's that cost of living adjustment that we did see a pretty significant cost of living adjustment this year. So that's a good sign that the government recognizes inflation is a big topic for retirees. Oftentimes pensions, however, if you're living on a pension or you have pension income, sometimes those cost of living adjustments aren't in the plan itself, or that you can't really guarantee them. Sometimes it's kind of at the discretion of the company that's paying them. So you got to watch out for that. And then obviously your 401k plans and your investments. If you're a retiree that is living on primarily the majority of your savings, maybe early on. So in that previous example where we may recommend a person hold off on taking Social Security, and you have to borrow and take from your investments to kind of bridge that gap.
Sure.
My recommendation to those investors is not to be too conservative, not to be too fearful of the market and buying individual stocks, because they, although they will go down, some stocks, particularly the household everyday items like food and alcohol,
like
tobacco,
your daily essentials.
The daily essentials,
Sure.
exactly. They have an automatic inflation adjustment built into them, and most individual stocks do, because the companies can price in to their products and services an inflation hedge. So, for instance, if cost of food goes up, we just pay more for it at wherever we're shopping. The companies can build in a little bit of a cost adjustment or inflation adjustment in the form of the price that we pay for products and services. So as a shareholder of those companies, you benefit from that pricing ability of
Sure.
a company. So that's what I would say to investors is continue. You have to continue to invest in. Yes, it may take a few years for these policies and procedures to take effect. So you don't want to have too short of a thought process with your financial plan. You need to have some short-term money, some medium-term strategies, and then also some long-term growth, investments.
Chaz, I like what you said, entering retirement debt-free is always a plus, right?
Mm-hmm.
So if you have the opportunity to actually maybe pay off some of that smaller debt that you have, then you're not going to be impacted by those interest rates. And one more thing that you mentioned was, some of the things that we go over at our economic summit. If any of you are interested in attending our economic summit this year, it's actually February 28th at the Hilton Gardens Inn in Levis Commons. You can visit our website at arhq.com, click on the events tab, and you can actually register to attend that event. It's a great event. And we cover a lot of different topics, and it's kind of like our State of the Union to give you a pretty good idea where things are headed into this year.
Yep.
I think a lot of people right now are certainly curious as to where things are headed this year. That semi-annual economic summit, again, coming up at the end of the month on the 28th. You can find more information and go ahead and reserve your seat, arhq.com. Chaz, I like how you said, I want to make sure I heard correctly. Did you call alcohol an everyday essential?
Yeah, pretty much. Alcohol, tobacco.
Sometimes
at least in a recession.
Sure. Whatever you need to get by. But again, there is always opportunity in high inflationary periods and high interest rate environments, and to figure out how to make those work for you. Sit down, speak with the team at America's Retirement Headquarters. Go to arhq.com or give a call, 419-794-3030.